We are excited to be continuing a series on the death of the 60-40, where we want to talk about stocks. They were experiencing a golden era at the same time as bonds.
In 1982, out of every 100 adults, only 9 were investing in the stock market. Within the 40-year period of time from 1980 to 2020, it was the perfect time to invest in stocks.
Kind of a classic supply and demand, right? If you've got more demand for stocks, more people buying, it's going to drive up the value of those stocks. Not only are you having more people participate, you're having more and more dollars participate. If we look specifically at 1980, there was about $100 billion invested. Look to 2020, that number went from $100 billion to $30 trillion.
Okay, hold on. Say that again.
100 billion to 30 trillion in 40 years.
300x. Absolutely massive growth.
The S&P 500 over that 40-year period returned over 12% per year. It grew 11,000% over that time period.
Absolutely.
Truly was a 40-year miracle. Welcome back to the Beyond the Noise podcast. My name is Max Clark. I'm a senior wealth advisor and partner here at the Fox Alliance. I'm joined by my co-host, Josh Renfro, our CIO and the managing partner here at our firm. We are excited to be continuing a series on the death of the 60-40. This is part 2. And part 1, we talked about the history of the 60-40, what kind of got us to this point. But then more specifically, we talked about the 40-year miracle, the period from 1980 to 2020, where the 60-40 portfolio performed exceptionally well. And we focused in last time on the 40% of that portfolio, the bond component, and how it had truly an exceptional period of performance. It is a period of performance like we've never seen in history. This was a once in a lifetime, once in history type of environment that we saw for bonds. It was an exceptional driver of performance for the 60-40. And this episode, we want to focus in on the 60% of the 60-40, where we want to talk about stocks and how they were experiencing a golden era at the same time as bonds. And so, Josh, let's dive into that a little bit here in this episode. I'm excited about what we have to cover.
Me too.
I think it'd be important for us to set the stage for, that 40-year miracle or that golden era for stocks by stepping back in history and looking at one of our darkest economic times in the United States, and that would be the Great Depression. So why don't you talk to us a little bit about the history there and how that impacted the psyche of investors at that time?
Yes, I think it's really important to remember, and like many things, it's the classic line, everyone's like, no, this is an overnight success, 30 years in the making.
Yeah.
In the same way, the investment trends that we benefit from today oftentimes are decades, or in the case of this trend, multiple decades previously in arrears. And so when we go back to the Great Depression, we see that. We have a horrible period of stock market ownership. Before that, we have a decade where we had the booming 20s, where the markets do really, really well. And we get to this time frame where the stock market crash is massive. We see an 89% drop in the Dow Jones Industrial Average.
2 or 3 years.
Yes.
And I think the thing that made it most impactful or most negative is that you had a lot of people that weren't on that train for the growth, and they got on the train right before it crashed.
Or even if they were, it didn't matter. When you lose 90%, it doesn't matter what growth you experience. Everything's basically gone at that point. The amount of bankruptcies that created completely impoverished people. There were people who committed suicide. People's psyche when it came to an investment standpoint was permanently altered. I remember my grandparents, my Nana and Papa, they were children of the Great Depression. They weren't investors during that period of time, but just hearing the stories from their parents made them so averse to investing. They did not once invest in the stock market in their entire lives. And they lived into their early 90s.
Yeah, your Nana passed away just a couple of years ago.
Yeah, 2 years ago, and my grandfather a year afterwards. And so literally would never invest in the market because of the pain that they experienced. And this kind of comes back to this concept in investing called recency bias.
Yeah.
We tend to think that what we've experienced recently is what is likely to continue. And so for us today, it's really hard to fathom that because guess what? We're living right now through the best 15 to 17 years of stock market performance ever seen in recorded U.S. history. On the flip side, back then, those individuals were living through it was the three worst years in U.S. stock market history. And so when that happened, you had stock market ownership spike in the roaring 20s, and then it completely fell off a cliff.
And the thing is, it didn't bounce back.
No.
It wasn't like, oh, great, we were back to the way it was.
No. Even by the 70s and 80s, the number had recovered to maybe 25 to 30% of the U.S. population was investing in stocks again. And then we have the recession of the 80s, and that number drops down in 1982 to 9.4%.
Yeah.
So literally, out of every 100 adults, only 9 were investing in the stock market. And that's the first major reason that we feel that we think that within the 40-year period of time from 1980 to 2020, it was the perfect time to invest in stocks, because generally the best growth occurs when you see a massive amount of new entrants investing and beginning to invest.
Classic supply and demand, right? If you've got more demand for stocks, more people buying, it's going to drive up the value of those stocks.
Bingo. So if you really think about it, as you said, supply and demand, stock prices come down to that simple factor. If you have more people buying it than selling it, it goes up. If you have more people selling it than buying it, it goes down. And so when you go from 9% of the US investing in it to, by the 2024, we were at 42%, a fourfold increase, and not just a fourfold increase, but those people were growing more wealthy. So it's magnified even more. That is a massive tailwind that pushes the markets forward for a really long period of time.
Absolutely. And so the thing that really drove the stock market during that time was a conglomeration of a lot of different things. That was obviously one of the real key components, is you have more and more people investing in the stock market or participating in the stock market here in the United States. Let's move on to the second one. Tell me about the second one.
So the second major reason that the markets did really well were the best companies went public. So if you think about it, investing in the stock market doesn't do you any good unless you get actually access to really good quality companies. And so back then, during that period of time, if you were a company and you wanted to raise a lot of new money, that's an important step. For most companies, the reason to go public, at least back during that period of time, was to raise more money. It was to have more money to grow, expand, or maybe to provide liquidity, or people who had invested in the business for a long time, a source of taking some of that money out. Those were usually the two predominant reasons. And so because there was really no other option, your best companies went public. Companies like IBM, Coca-Cola, Microsoft, and others were companies that chose to go public. They chose to become stocks on the stock exchange. And so investors, when they invested in these businesses, they got a chance to not just invest in a small subsection of the U.S. economy, but some of the best businesses and some of the fastest growing businesses in the United States today. So that's really the second major reason why this was an especially good period of time, because you truly were getting access to the best quality opportunities of the day.
And I think what was interesting about that time too is you got access to them early on.
Yes.
Before they really experienced a lot of their growth. Something that we've talked about before and recently, just this year, has been SpaceX and their listing on the NASDAQ. Really exciting opportunity that a lot of people were thrilled to participate in. But here's the reality. That company listed at almost $2 trillion in valuation. And they did so after being in business for 24 years.
Yeah.
You compare that to any of the big companies, Google, Nvidia, all of them. They all went public at far less than probably 50 billion. A lot of them probably went public.
Most of them were sub $1 billion.
Yeah.
I think Google was the one exception at like 1.2.
Yeah.
The rest, Amazon, 400 million.
Right.
I think Nvidia was 800 million.
I think Apple was maybe around the billion, but
I'm sorry, Apple.
Less.
Apple was 1.2. I think Google may have been actually around 5, but still
very
very small
small
by comparison.
Yeah. And the other thing that's interesting about them is they listed well before their 10th birthday.
Yes.
Right? I mean, so we're early on in the growth period, and investors are getting access to those great companies before they experience a significant
I think it's important for us to take a step back and talk about why is early important.
Yeah.
Okay. So if you think about NVIDIA, NVIDIA is the growth story everybody's been talking about for the last 3 or 4 years. Why? Because if you had put $1 into NVIDIA when it went public, today you would have
It's crazy. $1.
$1. An astronomical number. It's an astronomical number. And as a result, when you put that into the market, it supercharges things. When you can have a company grow like that, the broader market benefits massively. Amazon goes public at 400 million. It's now a multi-trillion-dollar company. That is a life-changing event. The amount of articles people have read about if you just put 10 grand into Amazon when it went public, you'd be a tens of millions of dollars in net worth at that time. And so two things are important there. One, when you get in early, you can have parabolic growth that is 10x, 20x, 30x, or even more than 100x. Those things are possible. Another side of it also is the risk that's involved. Even if Amazon had never became the multi-trillion-dollar company it was today, if at 400 million, for it to have a 10x return, all it had to do was grow to 4 billion.
Right.
Still challenging, not simple, but there's even back then, a lot of $4 billion companies. Compare that and contrast that to Meta, which goes public in the early 2010s at $100 billion valuation. For them to have a 10x return, what do they have to grow at? They have to grow to $1 trillion, which at that time, no $1 trillion companies at all. And really difficult. You have to have a very large market, a really good business model to make that happen. Not impossible, but a much more difficult thing to do.
Right.
And so back then, back to your point, with companies going earlier, one, you got a chance to experience that exponential growth curve for the companies that experienced it. And then secondly,
it was more secure.
It was a less risky entry point.
Right.
You had a higher chance, a higher probability of success.
And as all that's happening, people are excited about it. They're getting involved in it, and it drives more participation in the market.
Exactly.
So that kind of ties in a little bit to the third point. And the third point is we started to see more and more money flowing into the market just in general. Multiple reasons for that. One, we talked about participation rate already. We talked about growth in the stock market and getting access to these great companies. But I think one point that we haven't made yet is that, like we talked about in our last episode, interest rates were coming down. And so all of these people were invested in the bond market leading up to the 80s because you could get really high interest rates.
Sure.
It was a great place to be. And interest rates are starting to come down. And so people are saying, all right, I used to be able to get 16. Now I can get 8. Yeah. Now I can get 5. Now I can get 4. And what are they saying? Well, this is not the investment that it used to be.
Sure.
And I'm looking to get better returns. And I'm starting to see the Googles of the world go public. I'm starting to see the Apples of the world go public. That's something I want to participate in. And so their shift or move away from this focus on consistent income and the returns that you could get there drove a lot of people into stocks seeking higher returns.
Agreed.
There's this big drive for that.
There's this concept closely connected to that, which is this idea that you want to think about what is the risk-free rate for return, which most people would equate that with the 10-year U.S.
Treasury.
government bond.
Yeah.
And so when you're getting paid 16% and the risk is, hey, if the U.S. government defaults, then that's your risk. Well, that's a relatively low risk, especially back then.
Right.
So if I'm getting paid 16%, what does a company have to return in order to incentivize you to sell your bond
Something
and go and buy the
more
stock?
than that.
It has to be a lot more than that. Well, it's hard to get a 20, 25, 30% return from a stock. But as you said, as it goes from down to 10, now you need to earn 15, or if you're 8, now maybe 12 or 13 would incentivize you. And so as the interest rate of your risk-free option with the bond goes down, it's much more attractive to consider the stock market at that point.
Right. So fourth point that I think also contributes to more and more people participating, or at least I should say more and more dollars going into the stock market, had to do with this shift in the way that individuals were planning for retirement. Back in the day, prior, let's say in the 80s, there was a much greater dependence on pension plans.
Yes.
It was a significant number. I don't remember the specifics, but we saw a much higher number of employees, workers being dependent on pension plans versus investing the money themselves. And that began to change in the 70s and 80s. And that specifically occurred because we had the passage of the laws by Congress in the early 70s that created the IRA, the individual retirement account, which provided some tax shelter. You could invest for the long term with deferring your taxes until you take them out in retirement. And then 2, the 401k, which came a little bit later in the 70s. And so if we look specifically at 1980, there was about $100 billion invested in IRAs and employer-sponsored retirement plans, not pensions at that time. Look to 2020, that number went from $100 billion to $30 trillion.
Okay, hold on. Say that again.
100 billion to 30 trillion in 40 years.
300x. Absolutely massive growth.
And so as that occurs, like you were saying earlier, not only are you having more people participate, you're having more and more dollars participate. And that just compounds upon itself. And so that's a huge driver for the success that we saw in the stock market over that time period. You went from big institutions, pension plans managing that money, to individuals now having the ability to invest in the stock market.
And I think it's important to recognize the difference between those two groups. If you're a pension plan, your predominant concern is I pay out my obligations and I don't lose my shirt tail in this process.
Right.
Versus individual investors, their motivation's a bit different. It's like, I want to maximize my retirement future.
Right. This is my savings.
And so it's the kind of person that's generally going to be willing to take a little bit more risk if they feel like they can understand it. Versus the pension plan, it's not the same.
Absolutely. Absolutely. So with the 5th point here that I think's also really important has to do with global demand taking off. Do you want to talk to us a little bit about that?
Yes. So if you look back in the 1980s, ownership of U.S. stock market, foreign ownership was only set at about 5%.
That's right.
5% of the entire stock market was owned by foreign investors. You fast forward to today, that number has increased to 40%.
Wow. So
we see an 8x increase in the amount of foreign ownership. And there's a couple of reasons for that. One, if you think about, it's a little, once again, recency bias plays into a lot of facets of how we think about the world. One of those areas is, inflation. A lot of people think, hey, the US is having some problems with inflation, and we are. But by comparison, our inflation is relatively tame compared to a large chunk of the rest of the world. We have well-established capital markets, meaning ways to own companies and make loans to companies. We have good rules of law.
Yep.
The ability for private property to be seized is relatively small. And on top of that, because of the relatively low inflation, people's purchasing power remains relatively stable. You compare that to a lot of other countries, China, Russia, portions of South and Central America, Africa, even Europe. The inflation is much higher. And so all those things contribute. And on top of that, the US has a very entrepreneurial spirit. And so we have a lot of the major, large, fast-growing companies that ultimately are started here. And so a lot of investors are wanting to get involved with that. And so those tailwinds cause the foreign investor participation to increase dramatically as well.
Absolutely. And I think if we kind of combine that with our next point, it hits home even more significantly. And that has to do with the growth of the demographics, not only here in the United States, but around the world. And if we think about the significant impact of foreign investment here in the United States, we had not only more investment, but we had more people around the world being able to invest.
And spend.
Right. Let's talk a little bit about that. So we have here in the United States, between 1980 and 2020, we saw an increase of almost 50% in our population. We increased by about 100 million people over that time period, which is significant, obviously, right? So that means
millions of people buying
homes, investing, spending money, all of that. That's huge. You combine that, though, when we think about foreign investment and spending here in the United States with the global population growth, we saw the global population grow by about 3 billion people. And I think more significant than that is the growth of the middle class.
Yes.
So the middle class being people that have some, discretionary income.
Spenders.
They got spenders. They're investing. They're spending. They're being a catalyst to the economy and to the stock market. That middle class grew by 2.8 billion people over that 40-year period. And so when we think about more people investing in the United States from foreign countries, You go from 5% to 40%, like you said. That makes a lot of sense when you combine that with the reality that population exploded during that time. And not just population, but affluent population, right? Or a population that had the ability to invest and to spend money.
Which ties back to another major thing, which is the growth, not just the growth of population, but the actual economic growth.
Yes.
So if we look at the periods coming out of World War II, the US by decade had astronomically higher economic growth than we have today. And once again, that was more predominantly driven by rebuilding the world.
Yeah.
Think about it once again. After World War II, Europe is decimated. Large chunks of Asia are decimated. And the US is the only manufacturing base in the world that's still standing. So we benefit tremendously from helping to rebuild the rest of the world. So we have really strong economic growth for several decades coming out of that. It starts to decline, but still very high economic growth. We're still a key manufacturing power. That begins to change. And we see that economic growth begin to decline, but still, even in the 80s and 90s, we're still sitting at a really attractive 3 to 5% growth rate, which that kind of tailwinds it creates a lot of powerful forces that make it much easier for companies just in general across the board to grow. It's kind of like a rising tide. A rising tide lifts all boats. And when you have really good, strong, broader economic growth, you don't even have to be that great of a company to still see some pretty good,
people are spending
growth.
Money and they're buying your products. I mean,
That's
it's just kind of the way it goes.
Exactly.
Yeah. Hey, everyone. If you're enjoying the insights that we're bringing on this channel, do us a huge favor and hit the subscribe button on Apple, Spotify, wherever it is that you listen to your podcast. It takes 2 seconds, is completely free, and helps us continue to bring you high quality content. So another important point that has driven stocks so significantly, we talked about economic growth and participation in the markets and spending and all of that. What that ultimately led to over that same time period was a real expansion in profit growth. Right? So you saw companies seeing more revenue, seeing more products purchased. You saw their profits significantly expand. And when you see profits grow, what does that lead to? That leads to stock prices going up. And that was a huge component to seeing stock growth over that same time period.
Another point that kind of ties in with this is also the entire concept of globalization.
Yeah.
There are 2 levers that we see get pulled during this period of time. One, tremendous influx in new spending because the middle class grows so much, as we mentioned earlier. But the other thing we also see is not only do we get a chance to see the revenue grow because there's so much more spending, but we also have the ability to reduce the costs.
Yeah.
We end up outsourcing the manufacturing of a lot of goods
offshoring
to other parts of the world. So not only do we get to make more money because more money is coming in, but we also reduce the costs that we have for those same goods.
Again, this was kind of an impact of the World War II process, right? Where the United States became the global presence and ultimately led to free trade and ultimately led to this globalist economy that we've experienced.
Exactly. So we get 2 things that fuel profit growth for those last 4 decades. One, the massive middle class growth, but also very importantly, the low cost goods, which results in more profits in U.S. corporate pockets, and also the standard of living increasing for the average American as well, which means there's more disposable income for them to spend. So it becomes that kind of virtuous cycle on that side.
Absolutely. Innovation leading to decreased costs, greater standard of living for everybody, more spending. I mean, it was just a real positive economic time period and growth for stocks.
That's right.
The other key factor that we talked about for bonds already has to be interest rates declining, right?
Huge.
I mean, when you see interest rates declining, that doesn't just help bonds. That helps stocks. Talk to us a little bit about how that impacts stocks.
When you think about stock prices, there's this concept called price to earnings ratios. Earnings, just a fancy word for profits.
Right.
So a good way to think about it is if there's a Starbucks down the road here that makes $100,000 a year in profit, and you're willing to buy it for $500,000, that means that Starbucks has a price to earnings ratio of 5.
Right.
Because you were willing to pay 5 times the profits to purchase it. If we think about the S&P 500, the 500 largest companies in the U.S. stock market, and we look at the last 130 years, on an inflation and cyclically adjusted basis, the average price to earnings ratio has been about 17.5.
Right.
Meaning that people are willing to pay about $1,750,000 for a company that generates $100,000 of profit. Now, that might seem expensive to the average person, but we're typically talking about companies that maybe they're a monopoly in their category. At the very minimum, they're one of only a few, probably. Right. They have strong growth prospects. They probably have a significant moat, meaning it's difficult for new competitors to enter and compete against them. And they're also typically of a substantial size, usually. Right. But those are the type of multiples that people are willing to pay for these businesses.
When we talk about stock market valuations, that's what we're referring to.
Valuations, multiples, those are synonymous terms. So when as over time, in the same way as bonds gain in value from interest rates declining, the price to earnings ratio, or the multiple that a person is willing to pay for that company, tends to go up. Why? Because the risk-free rate of return that you can make in the form of a government bond is going down. So at 10%, price to earnings ratios might have been 15, 16, because, I can make a pretty attractive rate of return with the risk-free rate. Why would I invest in stocks? But as rates went down, and then once again back to 2008, then literally went to the zero bound, we put ourselves in a position where the risk-free rate was very low.
It was not a lot of risk, but you didn't make a lot of money.
There wasn't a lot of risk, but exactly. You couldn't make much money. And not just in as a rate of return, but as a real return.
Right.
Because remember, even if inflation's at 1%, if you're lucky 3% on a 10-year government bond, or 2 or 2.5%, you're making a real 1 or 1.5%.
That's right.
And so what that did was that drove up price to earnings ratios and the price that people were willing to pay for stocks. And if we look at those peak points in 2021, when interest rates were at the lowest points that they had ever been, we saw cyclically and inflation adjusted price to earnings ratios climb to about 38 or 39.
That's right.
Once again, what does that mean? That means people were willing to pay between 3.8 and $3.9 million for a company that generated $100,000 of profit.
Right.
Which, once again, seems crazy. But in the context of, hey, what are my alternatives? Investing is never an absolute thing. It's always about relative alternatives.
Right.
What can I get in a risk-free return versus in something that has risk in a particular business that I know well?
Yeah, somebody might look at that and be like, my goodness, that's so expensive. You're not going to make a lot. Well, yeah, but I'm making more than what I could make with the risk-free rate.
And to be fair, we really do think that is ridiculous and expensive, and we would not want to lean into a stock market that's expensively priced. But that's how the market is thinking about it, and why they would be willing to allow the price of something to get up that high.
I think the other component there as well is when you're investing in a company with valuations that high, you're also expecting them to grow, right? Yes. It's not like you're just, hey, we're going to be happy with the company where it is, and profits will end up, paying us back over time. You're expecting it to grow. And when interest rates are really low, companies can borrow money at very inexpensive rates.
Great point.
And go invest and, do capital expenditures and improve their profits over time.
Really key point, because once again, if interest rates on the risk-free side are, let's call it 3%, that means a lot of major corporations like an Apple, a Google, a Microsoft, these are very creditworthy companies. They don't have to pay much more than the risk-free rate. Maybe they were borrowing at 4% or 5%. Well, think about it. You don't have to make a very good return on whatever you're going to invest that money in order for that debt to be accretive, for it to make sense as an investment. If you can make, on a 5% loan, you can make 10, that's 5% additional return that you're making on top of the cost of debt that you're experiencing at that point in time. And so at that point, when interest rates are higher, the list of projects that make sense to do becomes a lot less, because maybe there's a lot of other projects that make 10%, but 10% doesn't help me, because I'm net neutral on my cost of capital, the cost of the interest that I'm paying. Versus when you're back at 5, now that 10% looks really attractive. There's a lot more projects.
I'm willing to borrow the money and go do that.
Exactly. And so this just kind of wrapping it up, putting a bow on it, as we look at the stock market, whether it's from the population growth, or the growth of the middle class, or the economic growth that we experience, the spending growth, or the participation in the market, there are a good half a dozen to dozen huge factors that any one of them by themselves would be a very large tailwind to the stock market. But the stock market doesn't just get one.
Right.
They get a good 7, 8, 9 of these different tailwinds that hit not just for a select period of time, but for a prolonged 3.5 to 4 decades, and they blow very strongly.
Yeah.
Which sets us up for ultimately what happens coming into 2021.
Right. And if we were to put some numbers to that, like how successful was this 40-year period, the S&P 500 over that 40-year period from 1980 to 2020 returned over 12% per year. To put that in a little bit more of a shocking number, it grew 11,000% over that time period. I mean, that's a huge number of growth. And that was all driven by all of these points that we've talked through today.
Absolutely.
Truly was a 40-year miracle. When you combine that with the 40-year miracle for bonds, no wonder the 60-40 did so well.
Yeah.
That portfolio returned great returns over that 40-year period because we experienced an environment for bonds that was like nothing we'd ever seen before, and stocks that was truly the golden era for stocks. And so ultimately the question that we're going to be asking ourselves is this going to continue? Is this something that we should expect to continue? And that's something that we'll cover in future episodes. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Investing includes risks, including fluctuating prices and loss of principal. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, and SIPC. The Fox Alliance Wealth Advisors is a separate entity from LPL Financial.